Gold has been stretched from managed money net positions for quite a while. A lot of those things have been lightened up and going in ETFs. So this is just a little liquidation. I think gold is first supports around 3,000. I don't think it stays much below that. The paradigm shift that's happening in the market of just a little bit more deflation finally accelerating in the U.S. stock market, and people finally getting it, is good for gold. But this is a little bit of long liquidation. I mean, gold's been one of the best performing major assets this year. It was outperformed by copper, but we know what's happening to copper. It's going down. So just some liquidation. I think it'll stabilize and eventually head to 4,000.
Gold's reputation as a passive safe haven is being redefined in real time. For decades, investors turned to it in moments of panic. But we may now be entering a phase where gold becomes a strategic cornerstone of portfolio resilience, not just reacting to volatility, but front-running it. The market isn't simply shifting, it's recalibrating. And that recalibration is being driven by one powerful force: deflation. In the clip you just heard, Bloomberg intelligence strategist Mike McGlone cuts through the noise with a thesis that demands attention. He explains that gold's recent dip, prompting headlines and short-term panic, is not a breakdown, but a technical shakeout. In his view, what we're seeing is long liquidation, a natural breather after a powerful run. Gold has outperformed most major assets this year, only briefly overtaken by copper. And now that copper is retreating, gold remains firmly in the spotlight. McGlone places first technical support around $3,000 per ounce and sees a path to $4,000, especially if the S&P 500 continues its descent toward that same level, where we could witness a historic 1-to-1 ratio between the two. To appreciate what's happening, we need to zoom out. As of Q1 2025, the S&P 500 has lost over 7% year-to-date. Bitcoin is down 12%. Meanwhile, long-duration U.S. Treasuries, tracked via ETFs like TLT, are up 6 to 7%, a strong indicator of capital shifting toward perceived safety and duration. Simultaneously, ETF flows into gold have flipped after nearly 4 years of persistent outflows. We've seen a notable uptick in gold ETF demand, indicating that both institutional and retail investors are moving back into hard assets. Central banks, too, continue to buy gold at a record pace, particularly in emerging markets like China, Turkey, and India. These aren't speculative plays, they're strategic reallocations amid growing concerns over currency stability and geopolitical volatility. So, what does this all mean? In today's video, we'll unpack Mike McGlone's insights across 3 pivotal themes. First, gold's positioning amid a deflating equity market. Second, its valuation relative to bonds and the emergence of a new capital hierarchy. And finally, the implications of this shift, from ETF positioning to central bank behavior, for the global financial system. Please watch, like, and share this video, subscribe to the channel, and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
It's worthy of the deflation that normally comes from the inflation that we had to the peak in 2022. We still haven't wiped out yet, and it's way overdue. Now we have a worthy catalyst for just reverting of the rapid advance of risk assets. So the thing that's working against our new Trump administration is they came into office with the U.S. stock market cap versus the rest of the world, the highest ever. We go back 50 years on that. Stock market cap to GDP, the highest in 100 years. Volatility at extremely low levels, but pre-existing trends in declining yields and declining energy prices. Now, those are stated goals of the Trump administration. I think they're going to get them. The key thing is right now, what's happening is a worthy catalyst for normal reversion. That's why, to me, I'm still very, very bearish most risk assets and the commodities, with the notable exception of gold. But the thing is, that's right now only within a normal cycle. What commodities always do, they get cheap after getting too expensive. So I'll go wherever you want. We can go wherever you want. So let's talk about start with the world's most significant commodity, WTI crude oil at $66 a barrel. Now that's near the low for the last 3 years, but for the last 20 years, every time it popped above 100, it didn't bottom till around 40. And now I think that's where it's going. It's just a question of time. So I'll end with this. I think by the time we get to the midterms, the average price of a gallon of gas in the U.S., which is around $3.20, is going to be closer to $2, which is going to be very good for Mr. Trump. What's the stated goal of the Trump administration? Lower energy prices, which means natural gas, which is still about $4 per MMBTU, and lower inflation. And they have pre-existing trends in their favor. And according to my view, is here, I'll give you one example. The average price of gasoline in this country is around $3.20 a gallon. We mentioned, and I think it's going to to two. But by the time they get to the midterms, that's going to be something they're going to say, hey, we got prices lower. But it's also what happens normally. And here's the key thing I think that market's underestimating is 55% of the people in this country are wage earners. The rich people who own a lot of property in stock markets didn't really vote for Mr. Trump. So if he gets the price of gasoline lower, the price of deal lower, the average mortgage rate much lower so they can buy homes, which are the highest relative to income ever, that's going to really help his constituents in the midterms and potentially by the time we get, but midterms are the next key thing for political to look for. But this is all going their way. And here's the number one way to get the Fed to ease and bond yields to go down is the stock market to go down. Because it's the reason they had to stop easing is because the stock market went up too much and created too much wealth. So I do enjoy that tilt. And let's just make it clear, it's massively deflationary, because you look at the nuances of maybe, it's a couple goods and services, just goods mostly, picks up the total trade balance in this country, imbalance is $1 trillion about. So let's say you add 20% on that, maybe that's through 200 to $300 billion. Let's do the math. So far this year, the market capitalization of the stock market's dropped almost about $5 trillion. That's many X's of what the kind of inflation you might get from good. That's the most significant deflationary forces. The deflating U.S. stock market, I'm saying, and from a market cap to GDP basis, it's the highest in 100 years. And it's just reverting now. So if we give back, we've already given back about half of last year's $12 trillion. That's deflation just getting started. So it might not show up in the numbers right away, but it's showing up in the bond market, and they get it. 4.04 in that U.S. Treasury note, which, by the way, is still over 230 basis points above what we see in China, 1.72. And I just have to remind people, I traded Japanese government bonds in 1995, and I've seen this before. Deflation on a global basis is accelerating. China is really pressuring it lower. And once that U.S. stock market goes down, it's kind of 1930s type deflation, just getting started. But it's normal. The book Price of Time by Edward Chancellor just pointed out we always get deflation after inflation, most notably when we pump liquidity. And also, I just love that book by Jeff Booth, The Price of Tomorrow, pointing out the deflationary forces of rapidly advancing technology. Just look at all this rapid technology that's being exported out of China, and the U.S. has to put tariffs on it to prevent, the collapsing our U.S. and the automakers, because they make better cars and are much cheaper.
As McGlone highlights, the unfolding deflationary forces in the U.S. stock market are part of a larger trend that's pushing us into a period of recalibration, one marked by deflationary pressures that could reverberate across global markets. But within that context, it's crucial to understand the specific catalysts driving these shifts. One of the most significant contributors is the economic policy of the Trump administration, particularly its approach to tariffs and trade wars. Earlier this month, President Trump implemented a sweeping set of tariffs affecting approximately $1.4 trillion in imports. These measures targeted a broad spectrum of trading partners, including traditional allies such as the European Union, Japan, and Mexico, with tariff rates varying by country. For instance, China faced a 54% tariff, the EU 20%, Vietnam 46%, Thailand 36%, Japan 24%, Cambodia 49%, and Taiwan 32%. This aggressive approach aims to address long-standing trade imbalances and bolster domestic manufacturing. Trump has also threatened to impose tariffs on pharmaceuticals to make countries more compliant. In response to these tariffs, U.S. companies have been reevaluating their manufacturing strategies. Southeast Asian nations like Vietnam, Thailand, Cambodia, and Malaysia have been attractive alternatives due to rising Chinese labor costs and the pursuit of friendshoring strategies. However, the newly imposed tariffs on these countries, ranging from 24% to 49%, have introduced significant uncertainties, potentially disrupting these supply chain adjustments. Mike McGlone believes these developments will have far-reaching consequences for the stock market, U.S. Treasury bonds, and commodities like gold and crude oil.
Gold is cheap versus the U.S. stock market historically, and it's just starting to break out. I love to look at that gold divided by S&P 500 ratio. It got well below, zero point 0.4 or so. Now it's jumping up to 0.6. It's probably going to go to 1-to-1. It's what it always does. That's ounces of gold divided by S&P 500. But if you compare gold to treasury bonds, like just taking GLD, the most widely traded gold ETF, divided by TLT, the most widely traded bond ETF, that ratio, gold is the most expensive ever. Now that's only 20 years. We have other data that goes back 50 years. So I think what's happening is going to happen is I'm still very bullish gold. I think eventually it gets to 4,000, and maybe it meets the S&P 500 at 1-to-1. S&P 500 4,000, gold 4,000. Maybe eventually gets there. But we're at the point now where it's stretched above $3,000 an ounce. It needs continued deflationary forces, which is happening from the stock market. Just a little bit hard today. We're hitting some stops like we did in 2008. The key thing is it's so expensive versus bonds. So I think what it's doing is gold is passing some of that deflationary rally, risk-off appreciation to the U.S. Treasury bond market. And to me, because I've been saying this for almost 2 years, that's probably the next big trade. U.S. Treasury long bonds at 4%, just catching up to where they are in China, below 2%. Gold has been stretched from managed money net positions for quite a while. A lot of those things have been lightened up and going in ETFs. So this is just a little liquidation. I think gold is first supports around 3,000. I don't think it stays much below that. The paradigm shift that's happening in the market of just a little bit more deflation finally accelerating in the U.S. stock market, people finally getting it, is good for gold. But this is a little bit of long liquidation. I mean, gold's been one of the best performing major assets this year. It was outperformed by copper, but we know what's happening to copper. It's going down. So just some liquidation. I think it'll stabilize and eventually head to 4,000. The key thing is if the U.S. stock market's dropping to S&P 500 towards 4,000, which I think that's good for gold to head towards 4,000. But again, that's very much significantly deflationary. And on the year right now, that U.S. Treasury long bond like TLT is up about 7%. Yeah, 6 to 7%. Bitcoin's down 12%. S&P 500 is down 7%. That's deflation just getting started. The point is it's so overdue. So still bullish gold. Pretty good support around $3,000. It might tick below that a little bit, but I think and I'm pretty sure these trends that we really accelerated today are going to continue, and that's just deflating risk assets. Means from here on, a long duration like a 30-year zero coupon bond might outperform gold. To me, what's happening in gold is what's most significant to mention, and we've had almost about 4 years of significant outflows in gold ETFs. That's flipped now. They've just shot up this year, completely tilted around. Investors are getting it like, yeah, I need some store value. I'm done. The S&P 500 was on a tear. Yields were higher, volatility was low. That was always a pressure factor in gold. That's switching. So investors are flipping towards gold. They're getting it. We've already seen the central bank buying, so I'm still quite bullish gold. I think this is just a blip in the trend. But what happens sometimes is you need one day to flip the narrative, and I think everybody gets it now. Risk assets, most notably risk assets, are for sale on rallies. Yes, that means they're going to be sharp short covering rallies. Gold, I think, is going to be bid on bought on dips, maybe around 3,000. The key thing that really triggered me is when Bitcoin hit $100,000 on that massive frenzy. That was a signal to buy gold, sell Bitcoin. And it's very similar to me in risk assets. It was very similar to me that when the NASDAQ printed 5,000, NASDAQ Composite in 2000, right about 25 years ago. And the key thing I like to point out is gold is great. It's zero correlated. In fact, it's negative correlation. Stock market's increasing, increasing. The negative correlation increasing. Yet the correlation of Bitcoin, sometimes people call it digital gold, the stock market's increasing. We're finding out that digital gold is actually much more of a leveraged beta. It's going down at a higher volatility in the stock market. And the difference is gold has three dependents: silver, platinum, and palladium. The only reason they're really going up is because gold's going up. People need to know that silver is not going to outperform gold in an environment like this, the stock market going down. It's unlikely. But Bitcoin was the first crypto in 2009. It had a great run. Everybody loves it. Now it has millions and millions, 13 million dependents based on what the data last on coinmarketcap.com. That's a problem. And you look at the next most significant, Ethereum looks like it's breaking down below 2,000. I just see that as we increase volatility in the stock market, as we take the stock market out, we're finding the cryptos, most of these, which are still silly expensive, are going to maybe lose a couple zeros of value, like stock market, like a lot of .coms did, and gold should continue to appreciate.
As we've seen from both Mike McGlone's analysis and the recent economic data, we are witnessing a pivotal moment in the global financial landscape. the aggressive tariff policies introduced by President Trump have far-reaching consequences, not only for the U.S. economy, but also for global trade dynamics. While these tariffs may serve to reshape the balance of power in the global marketplace, they also bring heightened risks, including market volatility, disrupted supply chains, and an increased likelihood of deflationary pressures. However, amidst this uncertainty, gold remains a key asset to watch. As the deflationary forces play out and markets respond to the shifting economic conditions, gold continues to shine as a store of value with the potential for significant appreciation. For investors, it's crucial to understand the long-term implications of these policies and prepare for a potential shift in global economic trends. With these market developments in mind, we encourage you to stay informed and engaged. Don't just react to the headlines. Take the time to assess how these factors might impact your investment strategy and long-term financial goals. For those looking to navigate these turbulent times, gold may offer a reliable hedge in an increasingly uncertain world. If you found this analysis insightful, make sure to stay tuned for more updates, give this video a thumbs up, and subscribe to the channel for more in-depth analysis. How are you positioning your investments in light of these developments? Leave your comments below, and let's continue this conversation. Thanks for watching.